Good morning, everyone, and thank you for joining us today. The FCA recently published their non-handbook final guidance paper, FG 21.3, to help advisors understand their expectations when advising on pension transfers and conversions, and therefore today's webinar is extremely timely. For those of you that don't know me, I'm Tony Clark, Intermediary Distribution Manager at Scottish Widows, and I'm joined on this session by Gareth Davies, our Specialist Business Development Manager, who will spend the next 40 minutes or so presenting the main content. Please do use the Q&A box on your screens to submit any questions you have at any point during the presentation. And please note that all questions are submitted anonymously, so we will keep a lookout for some key themes that we can answer towards the end of the session. This webinar is being recorded, and we will share the on-demand link with everyone who has registered for this session tomorrow. You can also request a certificate for this webinar by clicking a link that you'll see in the related content section on your screen. We have a handful of learning objectives today, and these will be as follows. To understand all of the finalised guidance contained in FG 21.03, to understand the context and the market drivers behind these updates, to discuss and agree what best practice looks like in the context of the examples it highlights, and an awareness of ongoing work by the FCA to assess suitability of DB advice. Today's event forms part of our exciting expert series where we take on some of the key issues in our industry to help you navigate the very changing market. We've been building this content for the last year, including a recent session on supporting vulnerable clients and a webinar next month on the lifetime allowance rules. So please do look out for links to these in emails and on our social channels in the next few weeks. Back to today. I don't want to waste any more time, so let's get started. Gareth, over to you, sir.
Thank you very much, Tony. Good morning, everybody. I'm not sure it's exciting, but I'll certainly try and make this next 40 minutes as interesting as possible. This is, for those of you who know me, this is quite a passion of mine, has been for many years, really. And I think this feels to me like the final, famous last words, final intervention from the regulator in terms of defining and assisting the defined benefit advice in terms of working out what good looks like. Before I get into the kind of main content of FG 21.3, I'm just going to provide a brief recap of where we've been for the last 12 months or so, and just signpost some of the helpful tools that have been released from the regulator recently. Firstly, just going to quickly touch on something I've mentioned in previous calls regarding the defined benefit transfer advice assessment tool. I think this is really to be commended, part of a series of updates from the regulator, demonstrating real transparency. We're always quick to criticise the regulator when they get things wrong, but I think credit where it's due. This demonstrates real transparency in terms of the defined benefit transfer advice market. And I would urge all advisors to take the time to have a look at this. It is worth mentioning that the tool itself is only relevant up to the contingent charge ban, PS 2006, which, as we know, was the big change as from October of last year. However, I think it's worth mentioning the main changes in PS 2006, the contingent charge ban, I think is pretty clear and self-explanatory. Probably the other big change that was announced at that time was the workplace pension requirement, something I'm going to revisit as we run through the presentation today. Notwithstanding those updates, which are due soon from the regulator to the tool, I think it's worth all advisors, as I said, using this tool to audit and potentially enhance all areas of your ongoing DB advice proposition. It's also worth mentioning that the regulator's scrutiny of the DB advice market isn't going anywhere. I said this is probably the last intervention, and I do expect it to be so, but that doesn't mean we're not going to be subject to 6 monthly data reporting requirements for some time to come, I believe. And the last data period was published earlier this year, and it took into account DB advice behaviours up until March 2020. So this was pre-contingent charge ban, pre-abridged advice, pre-workplace requirements, etc. What's positive is this was already showing positive trends as far as the regulator is concerned in the DB advice market, an improvement in conversion rates. And by conversion rates, what we mean is the percentage of clients who receive DB advice who then proceed to a transfer outcome. Now, the FCA's view when it comes to defined benefit as a legacy asset has remained consistent. There was talk of it changing at one point a few years ago, but it has remained consistent that they've held firm that in most cases their belief is that a transfer is not in the client's best interest. Their starting position has also remained consistent that you start from the position that a transfer isn't suitable. Now, bearing that in mind, this gives you a feel for where the FCA probably believe conversion rates should sit, i.e. sub 50%. The vast majority of people who receive some form of advice hang on to their DB benefit. Now, what's really positive, as you can see from the screen now, is that the conversion rates have improved up until March of last year, dropping from an average of 69% down to 57%. So a significant improvement. But there's something hidden in here which actually to me is more positive than that. The FCA have included triage. They've taken this into account in their conversion rate figures. And when triage is included, that 57% falls even further down to a 46% average. Now, that seems to be consistent with that premise that I gave you on the previous slide in terms of the majority of people should be hanging on to their DB pension in situ. Now, what's interesting to me is that they're including triage. Obviously, abridged advice didn't exist at that time, but I expect that to be included in further data collection exercises. And this shows the importance, I think, to all advisors of embracing all of the tools that are available to us now. And we have now complete clarity, I believe, around what good looks like in terms of triage, abridged advice, etc. And I'm going to cover that in a little while. The final point, and this is an area where actually this reads across far more broadly, I believe, than the market for DB advice as it is, the FCA's continued scrutiny in terms of what good value looks like, in terms of a product and an investment proposition. Worth drawing your attention very specifically to the bit in brackets on the screen. This is excluding ongoing advice charge. So we're not talking about your value proposition as advisors. We're talking very specifically here about our value proposition as product providers. And this has been an ongoing area of scrutiny. And this was further enhanced in two ways recently. Firstly, the requirement to benchmark a DB advice outcome and the product and investment solution that is being proposed to the client against an available workplace pension scheme. Now, we know the FCA have always been very clear they won't be a price regulator, but what they have cleverly done is they've basically looked across and borrowed the pension regulator's price cap of 75 bips, which applies in the workplace environment. The second thread to this is investment pathways. Again, very much aimed at the D2C market, something I'm not going to talk about in any detail this morning, but worth mentioning that consistency of approach from the regulator that there is a soft price cap with investment pathways, once again of 0.75. So it seems to me, pulling this stuff together, that there is now a level of consistency. What was once deemed as good value, which was probably way back from the RU 64 days, 1% stakeholder, etc., I think we've moved on now, we've moved beyond that, and we're now down at 0.75. That is clearly the benchmark that the FCA is setting in terms of what good looks like in terms of a product and investment value proposition. And I think we should all welcome that clarity. We can debate it and discuss it, but I think we'd rather have the clarity to know where the FCA's view is sitting in terms of value for money now, and especially when it comes to preventing consumer harm, which is always high on the regulator's agenda. So that's just a very brief kind of recap and summary. Let's now start to have a look at FG 2103. For those of you who've kind of been involved in the DB advice space, you'll remember this follows on directly from Policy Statement PS 2006, which was issued last year. Great to see the FCA issuing almost a how-to guide in conjunction with the policy statement. They issued Guidance Consultation GC 2001. And that was a brilliant guide, not just to DB advice, actually, and I may touch on this towards the end of the presentation, but applying, I believe, a lot of the principles can be applied to the retirement income advice space more broadly. So there's a lot of really cracking stuff contained in here. There was probably a few missing pieces, which I'm pleased to see the FCA has really kind of filled in the gaps, I think, in this final publication, this finalised guidance. As Tony quite rightly said, this is non-handbook guidance. This is not an update to COBS. This is purely a guide to best practice. But as I said, I think there's some stuff in here which is really, really useful, not just in the DB advice space, as I said, in the retirement income advice space more broadly, and I'll come back to that in a little while. So let's have a look at what the FCA have actually published. And this is the three kind of key areas that the FCA are looking at in FG 2103. So firstly, the way information is collected, the way the information is used in terms of the suitability of advice, and then the way that information is communicated to clients. As we know, DB advice is probably the most complex area, not just of pensions advice, but I actually believe of financial planning advice more broadly. And obviously, this is life-changing stuff for a lot of folk. Really interesting for me that DB, at its heart, is a transfer of risk. It's a transfer of risk from the employer to the end client, ultimately, if the transfer proceeds. And of course, there is also the additional complexity that the consumer is then responsible for paying charges, which they wouldn't have paid within the DB scheme, and obviously ongoing advice charges as well. And as I said, this is an area where the FCA believe consumer harm has occurred certainly since pension freedoms, as more and more people have been responsible for managing their investments in flexi access drawdown. We know that market absolutely ballooned 5 or 6 years ago and continues to dominate the decumulation space. So ensuring clients are best able to make informed decisions sits at the heart of all of this. Now, the good news is, as the FCA say, they've seen some really good, high-quality DB advice that has enabled consumers to make the best use of what for many people will be their largest legacy asset, not just pension asset, but potentially their largest legacy asset, okay? As I said, this is life-changing stuff at its heart, I believe. However, they're still seeing as well far too many poor practices, and a lot of this, as you can see on the screen, is due to either poor practices themselves or weak record keeping. And this is fundamentally important, more so in the area of DB advice than any other area of financial planning. And the reason for that is because of that starting premise. In any other area of a legacy asset review, we're probably starting with a blank piece of paper, working out the needs and objectives, and then seeing if it ties in with the asset as it exists today. In the area of DB advice, it's unique because the FCA gives you that starting premise that the consumer shouldn't be giving up that pension promise, okay? And as I said before, they believe that the majority of people will be best served by not giving up that pension promise. So therefore, if there is ever any element of uncertainty or if there is ever any lack of clarity in terms of the information that is being presented to the client, the default position should always revert back to that. Well, in the event of a kind of unclear outcome, we have to defer back to the regulator's starting premise, which is you hang on to this thing. And that's important to remember. As I said, DB is probably unlike any other area of financial planning in that regard. One more thing I just wanted to briefly remind you of. You've probably had a look at this already, but it's worth remembering the FCA also last year significantly bolstered their consumer section of their advice website. They launched an advice checker for consumers to use to check the quality of the DB advice that they had received. And I think there's some really interesting information on there. There's some useful information to help audit and, as I said, benchmark your advice proposition as it exists today. I also feel actually there's some really useful information on there to help you potentially enhance your triage proposition. There's some very balanced information on there in terms of reasons why you should transfer and also reasons why a transfer may not be in your best interest. So again, slightly detracting from the presentation to some extent, but I think it is still very important in terms of producing as rounded and as robust a DB advice proposition as possible. So let's get into the important stuff, which is actually what is the FCA telling us good looks like? And as I said, although on the front of this publication it does talk about advising on pension transfers, I'll stress again, I think there's some great stuff in here to be applied to the retirement income proposition of advisors more broadly. And as I said, I'll touch on that towards the end of the presentation. So as I said, this is non-handbook guidance, this is not COBS, this is for IFAs to use to audit, enhance your existing DB advice proposition, and credit to the regulator, they are explicitly articulating to us what good looks like, and I think this is to be wholly embraced and welcomed. As I've said before, in the area of DB advice, I think we've generally moved now from very high-level principles-based regulation to very narrow rules-based regulation. And I think it was important that we went on that journey, and I think it will be to the benefit of the DB advice market that we've now got such strong and clear levels of what good and poor practice looks like. Obviously, for the purpose of today's call, we'll focus on the good stuff. So, just quick actual trip down memory lane here in terms of where all this kicked off with CP 1925. Now, way back in 2019, the FCA published this consultation paper, and there's an example consumer DB advice journey in here, which to me I think is still very, very interesting and very, very appropriate in terms of advisors looking to construct as robust a proposition as possible. Now, I could be giving the regulator a bit too much credit here, but I think actually if you kind of squint at this slide, you can see a kind of funneling approach So obviously the biggest box is the consumers approaching the advisor, and the good news for everyone in the DB advice space, clearly demand is always going to outstrip supply as long as we've got freedom and choice in place, and personally I don't see that legislation being rolled back anytime soon. Again, famous last words there. But I think while ever we've got this kind of drive to consumer desire and ability to self-serve in terms of ultimate flexibility with your pension asset, then I think people are always going to want to have the DB conversation of, what's the value of my pension promise versus what's the value to me of my CETV. So in terms of this journey here, really, really interesting. Going back to the slide a few minutes ago where I talked about conversion rates, this is exactly the point I was making. My biggest concern was that the FCA would just look at the clients who receive full DB advice and then the percentage of those who then proceed to transfer. The good news is the FCA is looking at all of the touch points. Obviously, abridged advice, as I said, didn't exist in the latest data collection exercise, so they were including triage, but I would expect abridged advice to be included in future exercises. Now, as I said, you can see a kind of funneling approach here, where the largest box is the number of clients approaching for advice. We then see a funneling down of the clients who proceed to triage. And of course, there's many ways to do triage well. There's the online video services, there's written triage. There's many ways to fulfill that client service. And then we cross the line, and we cross the line clearly then into regulated advice when we get into personalised advice, and that's when abridged advice comes in. Again, we see a dropout as we move to abridged advice, and then obviously there will be another dropout as we then proceed to full advice. Now, I think this is really important if we're trying as an industry to demonstrate and use all of the tools that are available and demonstrate as robust a DB advice proposition as possible. Embracing all of these tools that are available, I think, is incredibly important. And record keeping becomes absolutely essential now, ensuring that from the first touch point, from the first time a client is triaged, right through to the eventual advice outcome, if applicable, we record keep all of the stages of the journey to ensure that we are mitigating that high conversion rate risk as much as possible. So let's move down through the DB advice journey. Start at the top, obviously. Let's start with triage. Pretty simple. I'm not going to spend very long on this because I think as an industry, we've kind of got our heads around this, it feels like now. This is non-regulated advice. This cannot be personalised to the client. It needs to be an off-the-peg generic solution, whether that's any of the fantastic online videos that are available or whether that's a written document. Ensuring that it's balanced, ensuring that it's not personalised to the client, and as I said, more importantly than anything almost now, ensuring that you record keep every time a triage document is issued out. Again, this is listed directly from FG 2103, so please obviously take the time to have a look at this if any of this is of any more interest. So we move on from triage. Let's move on to actually for me, the most interesting, and dare I use Tony's expression here, exciting change actually in terms of the additional information we've had from GC 2001 to FG 2103. Abridged advice, I'll be honest, I went on a bit of a journey with abridged advice. When it was first discussed, I had concerns about it. I didn't think we quite understood or we were given the information to be able to construct a robust enough abridged advice proposition because we didn't have the clarity in terms of what can and can't be included. And I also worried there would be a blurring of the lines between advice and guidance. Where does abridged advice sit? It's fair to say because of this publication, I've now completely changed my view. I think it's an invaluable tool. I think it does two things really well. I think firstly, it improves access to DB advice because generally it will be done at a vastly reduced cost to full advice. Although obviously you're free to set your own remuneration models as always. So abridged advice should help consumer access to DB advice in so much as we can give a personalised advice proposition here. But I think for you as advisors, this is really important because this will act as an additional stage in the client filtering process. So again, this will help improve conversion rates. Abridged advice can only lead to one advised outcome, and that is a personal recommendation not to transfer. Now, for those of you, again, who know me, you'll know as long as I've been talking about DB advice, I've been talking about cash flow modelling and the need to embrace cash flow modelling as part of a robust and clear DB advice customer-facing proposition. So I'm going to come back to that in a second. The second outcome, a non-advised outcome, is a conclusion that actually we can't give you a conclusion, basically. We can't, from the information you've given us, the fact-finding, the risk profiling, we can't give you a recommendation, so therefore it is now entirely up to you, Mr. or Mrs. Client. Do you want to proceed to full advice? And obviously important to stress the cost of full advice. The cost of abridged advice should be offset against the cost of full advice, so the client doesn't feel and isn't paid twice for the same kind of processes. So as I said, a personal recommendation not to transfer, or a conclusion that actually we can't give you a conclusion, so therefore it's up to you if you wish to proceed to the next stage. Now, brilliantly, the FCA don't just leave it there. They give us the clear articulation of how we can describe a two-stage advice process to our clients. Stage 1 and Stage 2, they describe it as, again, we don't have to take this word for word from the FCA finalised guidance, but I think this is a really useful description of the difference between abridged advice and full advice, describing it as that two-stage process. This is the bit that is actually interesting and exciting to me. If I could have asked for one thing from the regulator in terms of the missing piece of the jigsaw in the area of abridged advice, it would have been this. I think if you are going to make a personalised recommendation to not transfer, to keep your DB pension promise in situ, I think it's vital that cash flow modelling has to form a part of that process. I think it's very difficult to demonstrate that an asset meets a client's needs and objectives clearly and succinctly without a cash flow modelling exercise. And this is the big change that was, I think, hidden away. I'd have personally headlined this because I think this is massive. So again, obviously we start from the assumption that a transfer won't be suitable. So we start from exactly the same starting premise. So we have consistency there. But what the FCA have now said, in addition to previous publications, is you can now include a model of the benefits from the DB scheme, and I will stress again, and I make no apologies for stressing that, this is the pension we are modelling. We cannot model or comment on the CETV or transfer value, but we can model the pension promise, and we can use early retirement factors if the client's proposing to potentially retire early. We can revalue it up to NRD, as you can see on the screen, if we're doing this exercise at some point in time in the future. So this, to me, is absolutely the final piece, as I said, the final missing piece in the puzzle that really gives me confidence now in the robustness of abridged advice as a standalone, brand new advice proposition to give maximum benefit to the clients, importantly, but also probably just about as importantly to help advisors mitigate the risk of high conversion rates by not embracing these tools and just proceeding straight to full advice. So as I said, brilliant addition from the FCA there. I'm sure they weren't listening to me, and it's not on the back of my own kind of discussions on this, but it doesn't matter how it's come about. This is incredibly important development that actually you can now model the pension promise, and I'll stress it again, not the CETV, very much the pension promise as part of your abridged advice proposition. Now, I'm completely aware that the trends we've seen, and one of the first slides, actually, I didn't mention it, but it touched on the fact that there have been a significant reduction in numbers of advisors operating in the DB advice space for well-documented reasons I don't need to cover here. So what we see and a trend we expect to continue is that firms outsource this particular specialist area of advice, and we'll probably see that continuing while ever we see the kind of tough regulatory regime that we see imposed on the DB advice model today. So more and more advisors will outsource this, and there's many options, and do speak to your sort of local Scottish Widows business development manager if you need any help with these types of conversations. But I think it's perfectly acceptable. The FCA is completely comfortable that advisors actually outsource this. Obviously, PI is becoming more challenging. As I said, it's certainly become a challenging environment in which to operate, and we all understand that. There is an important point to be made here, though, and that is around clarity of roles and responsibilities in a two-advisor model. The advisor that is operating and has the permissions to give the DB advice is responsible, obviously, for that part of the regulated activity. And so, realistically, they need to have ownership of all aspects of that advice process, potentially even from the information gathering stage. And this is really, really important. So for those of you on the call who take business from other advisors, And for those of you on the call who refer business out to DB specialists, it is incredibly important that you have robust and ongoing due diligence conversations with the third party that's involved here to ensure that you have complete clarity around roles and responsibilities, who's responsible for what, and in terms of the DB advice process, that's a regulated, obviously, activity that needs to sit with the person who holds the permissions. Now, again, the beauty of the publication the FCA have given us here is they've really made it so you can kind of lift and drop best practice directly from it. And again, there's something that was kind of a subtle change, but I think an important change that's hidden away on this slide in terms of disclosure. So I'm not going to comment on advisor remuneration models. That's your value proposition. That's obviously for you to agree independently. And clearly the FCA don't set price caps in terms of advisor remuneration. They may, and they do and have obviously influenced how you get paid in terms of the ban on contingent charging, but they still are not interfering in terms of the amounts that you get paid, which is great news. However, this is what's interesting. If you look at the abridged advice on the bottom right of the slide, I think, as it appears on your screen, this figure actually changed between GC 2001 and FG 2013. So I think from memory in GC 2001, the cost of abridged advice as an example, and again, just to stress, these are not price caps, as an example, the FCA was talking about £250. Very interesting on this slide, that is the bit that has changed, and it's changed from £250 to £900. And that says a couple of things to me. Firstly, the FCA is now completely cognizant and mindful of the fact that abridged advice, there is a lot of work. Even though you can't do the APTA, you can't do the TVC, a lot goes into abridged advice. And now you're able to cash flow model the pension promise. I think that's even more so. Secondly, I think the FCA is realising, even without the addition of cash flow modelling in this particular publication, which, as I said, is to be welcomed, the FCA is very mindful that probably £250, it was very difficult for advisors to offer abridged advice, including the fact-finding, the risk profiling, et cetera. Obviously, as I say, not the APTA and the TVC commentary. And so it's good to see that they've listened to the market and they've upped that figure to £900. As I said, that doesn't mean you have to charge £900, doesn't mean you have to charge £250, doesn't mean you have to charge anything, but it's just, I think, an important little side note in terms of a change of direction from the regulator. And as I said, the beauty is we now have to disclose, we know the format that we have to disclose personalised charges, we know when, basically up front, we have to disclose this stuff now, and the FCA is giving you the template here in this publication. So, you know, not only have they published PS 2006, a very comprehensive policy statement on DB advice, they've then published a how-to guide, which they've subsequently enhanced with the information that you're seeing on your screen this morning. As I said, all to be welcomed. Pension freedom and choice probably caught the FCA on the hop just as much as it did many of us as providers. It's good to see regulation catching up, certainly in such an important area as DB advice. So for the last 10 or 15 minutes, I want to get into something that's a little bit more subjective. Some terms that we've had in the industry for probably a couple of years or so now, in terms of attitude to transfer and certainly capacity for loss. And this is the section of the presentation, the final section, where, as I said to you before, this best practice, I believe, can be incorporated in far more broad ways than just a narrow DB advice proposition. If I was any advisor operating in the retirement income space, these next few slides, these next few areas of best practice, I think are incredibly useful in terms of building a robust decumulation advice proposition. And I think it is worth me just kind of signposting, although it's been, I believe, deferred again towards the end of this year, we do still expect ASR2, Assessing Suitability Review 2, to be along in the next sort of 6 months or so, and that is going to be squarely focused on the decumulation space. I personally believe retirement income advice will receive, from the end of this year and for probably several years beyond, will receive the same level of scrutiny as DB advice has been receiving over the last few years since pension freedom and choice. So just a kind of a headline there, heads up in terms of potential future direction of regulatory travel. So establishing needs and objectives obviously sits at the heart of any financial planning exercise, I think it's fair to say. But for the purposes of this presentation, we're talking specifically about DB advice. But as I mentioned, this also clearly applies to the more broad areas of retirement income advice. So establishing needs and objectives sits at the heart of establishing a good customer outcome and presenting a recommendation to the client. Now, a phrase that isn't used here, but actually one I've heard used, and I really like it, and you must forgive me, I can't remember who I heard it from, but I think it's brilliant, so I'm going to steal it, and I will give due credit to whoever it was when I remember, this is about prioritizing needs over objectives. I think we've seen as an industry too many poor outcomes in the area of DB advice when we focused on objectives, because the client is generally wanting to talk about objectives. I get that. Objectives are nice things usually. They're retirement, the benefits of retirement, the nice aspect of retirement. But of course, we must remember that the first duty for us all is to secure the client needs before we can move on to the objectives. So again, apologies for the person I've stolen it from, but the prioritization of needs versus objectives, I think, is incredibly important here. So the FCA talks about a process that you can go through, an example process. Again, you don't need to word for word adopt this, but I think it's an incredibly useful structure that you could consider. Firstly, a clear identification. Then I think a prioritization, as I said, probably missed out of this publication, and obviously work out where conflicts are occurring, and then working through compromises. With a clear rationale for each decision. And again, cash flow modelling clearly just absolutely jumps off the page at me at this point as being a way to satisfy that. Now, I know most advisors will probably break down client expenditure already into several tiers. Again, there's no right and wrong way of doing this, whether it's DB advice or, as I said, the retirement income advice more broadly. But using the naming conventions that the FCA is giving us here, they've given us 3 tiers of expenditure, and they've named them essential, lifestyle, and discretionary. As I said, the naming conventions will obviously change, and indeed the number of tiers may well change, but I think the basic premise here is a sound one. But not only has the FCA given us the naming conventions that they suggest that we could use, essential, lifestyle, and discretionary, but they've given us further meat on the bones here in terms of, well, what sits beneath those definitions? So essential, what could that consist of? Lifestyle, and then discretionary. As I said, absolutely credit where it's due from the regulator for helping us with this. And I think the final piece, which is really going above and beyond, really, they've almost given us the kind of exam questions here that we can ask the clients as part of this process. So they've given you sample questions, open-ended questions, in terms of establishing client objectives, establishing needs, and then working through that balance and compromise process of needs versus objectives. So really, really good stuff from the regulator in terms of a how-to manual to accompany, as I said, a policy statement, which is absolutely brilliant in my view. Now, this attitude to transfer phrase, I think first reared its head in 2018 with PS 18.6 and then latterly 18.20, I think it was. And the FCA talked about we have to establish the client's attitude to transfer, but very much like capacity for loss, I don't think they gave us necessarily enough about what that actually means and certainly what good looks like. And I know some of us kind of thought, well, is this just another iteration of attitude to risk? Where does this sit in relation to that? Again, the FCA have gone above and beyond here and said, this is not about a standardized risk profile questionnaire, which clearly captures attitude to investment risk, and most advisor firms will clearly now have not only a CIP, a centralized investment proposition, but a centralized retirement proposition, a CRP as well. The FCA is clarifying here that's great and that's good, but that won't tick the attitude to transfer risk box. So again, the FCA have given us a kind of sample process to follow through in terms of, well, what does good look like when establishing or trying to establish attitude to transfer? Again, a range of balance questions. If we notice, the word balance comes out a lot in this document, and I think as an industry, as I said, in the area of DB advice like no other, we can't be seen to be sort of leading the witness. We have to give the client a balanced set of questions, a balanced view in terms of the ultimate recommendation, and goes right back to triage, doesn't it? You need to give the client, even from the first touch point, the first educational piece, good balanced information that doesn't lead them to kind of conclude a certain outcome is right for them, certainly not too early in the process. So the FCA talks us through the process that they recommend there, which I think is absolutely brilliant, talks you through open questions, gives you some examples, talks about, obviously, volatility. Again, I was fortunate enough to join this industry sort of 30 years ago, and at the time I worked for Norwich Union in Sheffield. I was also enrolled into their final salary pension scheme. I can't say at any point I opened a statement from the trustees for the 7 or 8 years I was there and looked at where that scheme was invested, because kind of didn't care. The pension promise was what was important to me. How they did that was not my problem. And this is the point about DB and pension freedoms more broadly. This is clients taking on investment risk that they may never have done before. So it's important that they understand that transfer of risk and they're comfortable with it. And again, the FCA gives you a good process or an example of good practice in terms of assessing transfer risk, attitude to transfer risk, and secondly on this slide, capacity for loss. And I know capacity for loss has been talked about in this industry for what seems like many, many years now. But I think this document is a brilliant way of clarifying what the FCA means by this. I think we all tried to kind of come to our own conclusions over the last few years, but the FCA have now filled in those blanks for us. So they've talked about capacity for loss, the definition of it, which I don't think we've necessarily had previously. So the customer's ability to absorb falls in the value of their investment. So different to attitude to risk, and a three-stage process in terms of this is what good looks like in terms of your ability to assess the client's capacity for loss. If you can clearly evidence that you're able to understand their essential income needs, goes right back to that segmentation, understand how far the DB meets those needs. And again, this is very important in the broader retirement income space. I think as an industry, we don't demonstrate the value of a risk-free return, which essentially a DB scheme is, notwithstanding the possibility of default, and then obviously the PPF underpin, which again we can illustrate quite clearly to a client. We need to start with the risk-free return and work back from there. So actually, this is the cost of a risk-free return. This is what it provides you. Does it work for you? And if it's yes, no, maybe, then we proceed to the next stage. And of course, it's not even necessarily a binary outcome of one or the other, as we know. We can give the client certain levels of income underpins with partial transfers, partial annuitization throughout their retirement journey, etc. So I think the key phrase here that kind of brings it home to me is the final one here. It depends upon how reliant you are on that DB pension promise. Have I got other assets in retirement? Am I married? Has my spouse got the benefit of a DB scheme? Have I got other investments, potential inheritances in the future? Where does the DB sit? Or am I completely dependent on that? So again, a good articulation from the regulator that I think really helps us demonstrate compliance, and also, we must never forget, give as robust a client proposition as possible. So a couple of final points for me for the last sort of 5 minutes or so. Again, the FCA given us a little bit more information about the TVC. Now, the TVC obviously replaced essentially critical yield, I suppose. And I think as an industry, again, we probably reacted a little bit negatively to the TVC because it kind of gave us a metric which was almost impossible to beat. But I think that was the point of it. If the client wants that risk-free return in that shape, then they've already got that in the bank, basically. This harks back to me to the days of critical yield when we used to talk about, how much risk are you prepared to take to beat that critical yield to give you a better return. For me, that was always a flawed discussion, and certainly pension freedom and choice killed that off, I think, once and for all. It was never about the size of the critical yield. It was about the relevance of the critical yield, i.e., does that income, does that benefit in that shape work for you? And if so, why bother taking any risk? And I think the TVC is just a better way, actually, of articulating that in terms of that's your risk-free return. And unless you can buy an enhanced annuity and beat that, and it is always worth kind of exploring that and evidencing that conversation with the client, because clearly one of the downsides of DB the pension promise doesn't take into account the client's specific health conditions and situation, and it could be that we can just straightforward beat that income by getting them a nice, robustly underwritten annuity proposition. But again, I love the final sentence here, and I think this is the more broad freedom and choice conversation that as advisors and as an industry, we've got to get as good as we can at, which is demonstrating to the client the price of flexibility. Because if I was to ask any number of clients, do you want flexibility in retirement? I think the answer would come back 100% yes. But of course, that's a very leading question, because if I've already got a risk-free benefit in retirement, at what price does that flexibility come? And this comes back to the point I was making before about the importance of an annuity conversation forming part of every retirement income conversation. So moving on from the TVC, let's have a look at the APTA. Again, the FCA have given us far more information in terms of what good looks like in terms of an APTA. They've also given us some clarity here in terms of, where a DB actually does clearly make sense, and the APTA should be used to demonstrate that in terms of a client who's potentially in poor health. And as I mentioned before, enhanced annuity quotes and enhanced annuity income figures should very much form a part of this conversation for all DB and all retirement income conversations. A couple of areas of best practice, which we must never forget, are still incredibly important. Please ensure, as part of your data gathering exercises, you are always asking the question as to whether schemes will accept a request for a partial transfer. As I mentioned earlier in the presentation, this is not always a binary conversation. It could be that we can secure their income needs and give the client some flexibility to achieve their objectives, certainly probably in the early years of their retirement at exactly the same time. And I think it's about 1 in 6 schemes are offering partial transfers now, and I only see that number rising over the years as schemes look to A, offer clients as many options as possible, and B, look to de-risk, quite frankly, as much as they can and get as much risk off the books as they can. So please ensure we are asking the question every single time of whether the scheme actually allows this. And the second point on this slide, again, it's important to note that some people will be in the fortunate position that they may have multiple DB schemes. And of course, each one is an advice point in and of itself. And as I said, it could be possible the client can secure a risk-free income to meet their needs and then transfer one of their other benefits to meet their objectives in retirement. Cash flow modelling is something that's I've been very passionate about in this advice space. I believe that there's some great software out there, some great third-party cash flow providers, and obviously it's up to every advisor to do your due diligence on providers and ensure it provides everything you need it to do. For me, though, there's a couple of points to make. Firstly, stress testing of cash flow modelling has never been more important. We've got to try and make it as real as possible. We've got to try and illustrate that transfer of risk. And obviously, if a client is moving into Flexi Access Drawdown, is doing a switch to a DC environment, there's going to be some investment risk, almost certainly, to achieve their objectives in retirement. So we need to demonstrate that. So for me, cash flow models should be stress tested in 3 ways. They should be stress tested for volatility. We should show the client the impact of volatile markets, and goodness knows the last 12 months or so have certainly brought that home once again in terms of the importance of being able to ride out volatility. We see some great models for drawdown now, advisors using bespoke portfolios, using 2 or 3 pots to segment income into short-term and medium and longer-term needs. There's obviously many ways to deal with this, but again, the stress testing of the cash flow model to demonstrate that investment volatility is key. I would also be stress testing for mortality. So show the clients in terms of when their likely expected date of death is based on ONS stats, probably I would take from that, and then show them the impact that would have on the DB income. So if they've got a dependent, maybe a 50% dependence pension kicks in at that point, and then show them the residual fund that would be available if the transfer went through. And then finally, longevity. Probably one of the biggest risks a client has to consider when looking at DB and potentially transferring this asset is a longevity risk where the client outlives the pension and they weren't planning to. Some people use DB assets as bridging pensions to state pensions. Again, this is not about sustainable withdrawal rates and ensuring the pension outlives the client, but obviously understanding the client's needs and objectives. Is that an important objective? Is the cascade of assets down to future beneficiaries important? And as you can see on the slide, the biggest and realistically main risk for a DB scheme of not being able to provide the income is obviously default risk, something we should probably never be commenting on because we won't understand the financial position well enough of the employer, I suspect. But what we can do is we can clearly comment on the underpin that sits behind all DB schemes, the Pension Protection Fund, sweeping statement, but will generally underpin 90% of the retirement income. So we should be making that clear to the client because there will be folk, especially in these troubled economic times and troubled times more generally that will be concerned about the financial health and well-being of their employer. We can hopefully allay some of those fears by modelling the PPF as part of the cash flow model. The final point I would make, which is just Gareth's tip really, it's not included in this document, is I would always get the client to specifically sign off on the assumptions we use within the cash flow model. So again, our growth rate assumptions, which should obviously tie into their risk profiling that we've taken them through, our interest rate assumptions and our inflation assumptions. So again, I would get the client to specifically sign off. The final points, obviously, from me in terms of this presentation, clearly the suitability report is fundamental to the recommendation. The cash flow model is a fundamental part of the suitability report. And again, the FCA give you some great good practice around what good looks like. And the final bit from me is this real plea to try and standardise. We're dreadful of it as an industry, I think it's fair to say, to try and standardise data collection and data delivery, and credit again to the FCA and the pensions regulator in association with the Pensions Administration Standards Association. They've put together a potential scheme data template, which I hope to see adopted throughout the industry to make all of our lives easier. If you want any more information on anything I've talked about today, everything will be available on our dedicated Defined Benefit Advice Hub, our Change Hub page. You can see the website there. As Tony quite rightly said, this is part of a broader package of support for your business, from expert series through to thought leadership and various other digital events. And of course, and I'm not just saying this because I happen to write for it from time to time, Tech Talk, I believe, is still the leading industry technical resource. So please, if you haven't subscribed to that, then please do so. Hopefully you'll agree in this relatively short time we've managed to cover off the learning outcomes as they were presented to you this morning. That concludes my part of the presentation. I will just now hand over to Tony in case there are any questions which we can pick up now. Tony, over to you.
Thank you, Gareth. Really been a whistle-stop tour of this particular subject, and thank you very much for leading us through this. There are a number of questions. I am conscious of time, and some of them are quite specific, so we can definitely pick those up post-call. So we will get a list of all the questions that have come through, and we can pick them up. I guess one general one, which the questions came as the subject was being spoken about in more depth, Gareth, was around triage and abridged advice, and whether or not you had a view on the moving to full advice from abridged if you just feel the outcome is unclear. There seemed to be a general sense that if you can't make some of the comparisons using some of the kind of the cash flow modelling, etc., actually, do you get to a point where you just can't give any advice because of a lack of clarity you can't actually give the advice without moving to the full advice process, if that makes sense?
Yeah, 100%, and I would agree with that. As I said, DB advice is probably the most complex and nuanced area, I think, of financial planning. As I said, I'm probably biased. I take a very distinct interest in this. But I 100% agree with that. I think there will be a large number of clients who, even post-fact find, post-risk profiling questionnaire, and even potentially now with the benefit of the cash flow model, there will still be some question marks, and it will need to go to an APTA. And obviously, look at the TVC. You won't be able to make an advised outcome without that. And that's the important, really, distinction between abridged advice and full advice is the APTA and the TVC. So 100%, as I said, I still think it's a very useful tool. I would still embrace it myself, and I think the extra clarity we've been given in here is important, and I think it will help that conversion rate conversation in the future. But you're absolutely right. I think there will be a number of clients who are unclear, and for whatever reason they may not wish to proceed any further. That's absolutely fine.
Thank you, Gareth. I would love to cover off one or two of the others, but I am conscious of time, so we will pick those up post the call. Thank you all for attending today. As I did mention at the start, the recording of the session will be emailed to you all tomorrow, but do get in touch with any relevant relationship team if you have any specific questions with your relationship team within Scottish Widows. Please do so. As we close this webinar, a feedback survey will appear on your screen. This shouldn't take any longer than 1 minute to complete, and it really helps us to plan future editions of the Expert Series. So it would be much appreciated if you were able to leave your thoughts. That's all for today, but do look out for more info on future webinars and content coming out shortly. Thank you all. Thank you, Gareth, and goodbye.